everybody. We kind of knew the 10:15 Friday session was, well, I'll say it's packed because Noah's videotaping it and it's facing this way. So thank you to the hundreds of people who attended. So for our panel, multifamily is obviously a very hot asset, has been for years, and while we've been talking about it in all these other panels these past couple of days, there hasn't been a multifamily specific panel, so that's kind of what we're talking about. Unfortunately, Jim from Bascom was stranded at the Houston airport due to weather yesterday, so he's not here. So we do have a great panel. We try to go across all different levels of multifamily as well as types. So we've got acquisitions, we've got finance, we've got institutional finance. To give everyone a pretty broad view of where we see the market, because obviously year over year we've been seeing cap rates compress, prices increase. So the question really was, what's been causing that? How are people handling that to continue doing deals? And where do we see this kind of ending on the back end of this? What's going to transpire that maybe gets prices down a little bit, or is it just a matter of buyers getting more comfortable with the higher prices? So we'll start off with introductions. Everyone can introduce themselves, where they work, and a little bit about their thoughts on the multifamily market. So we'll start down at the end there.
Good morning. My name is Dave Christensen. I'm with Money 360. We're a discretionary debt fund and clearly a chair cover business manufacturer for all conferences. That seems to be one of our leading pieces. And I understand if you cut holes on the side and the top, it makes a very good muscle shirt. So feel free. Money 360, as you may have heard from other panels, we are a discretionary debt fund for bridge lending, kind of $3 million to $30 million. We handle all property types. We do handle multifamily. For us, bridge and multifamily space is an area where somebody else who's got an agency financing and a bridge to that, it's a little bit heavier lift. It's a little bit different direction that the sponsor wants to go to, and that's where we can play in that space. We've got. Should I go on with? Open it to the group here. A little bit of our first discussion point, or you just want to go through introductions?
We'll go through introductions first. And
Okay.
All right, absolutely. Good morning, everyone. Chad Musgrove, Hunt Real Estate Capital. We're an agency, bridge, and balance sheet lender. So on the agency side, on the Fannie Freddie HUD business. Hunt itself is a diversified company. We're actually an owner-operator. We're a tax credit syndicator. And then we have various other verticals across the construction and investment management space. In particular, I would say I probably focus more on kind of the institutional agency, multifamily, but we'll look at the other food groups as well. So starting on the multifamily side, loans $1 million and up. On a bridge and balance sheet, we'll look at multifamily loans $5 million and above, and on the non-multifamily assets, which we like to kind of stay in the main food groups, office, industrial, some self-storage, a little bit of retail. Probably the only thing we stay away from are hotels. And in that space, we look at around $7.5 million and above. And we operate all across the country.
Good morning, everyone. My name is Noah Miller. I am the Vice President of Acquisitions and Finance at Pensam Capital. We're a private real estate investment group based here in Miami, Florida. We focus strictly on multifamily, and we currently have a portfolio of roughly 20,000 units through a couple different platforms, a direct equity platform where we are owner-operators, as well as a preferred equity program where we invest with other sponsors up to usually 85 or 90% of the capital stack. In addition to that, we started a development arm a couple of years ago. We've developed 2 deals so far, and we're about to break ground on our 3rd deal. And we also on the side have a lending business that we can talk about how we kind of differ from these guys on the stage. Usually what we're investing in is your standard market rate, multifamily, garden style, suburban properties, class A, B, and C.
All right, and my name is George Kruse. I'm the principal of Pursuit CRE, and I'll be moderating this panel. Pursuit kind of touches all aspects of multifamily. We've got 3 basic arms. One that's rarely used but still there is a brokerage arm. We work with buyers and investors who are acquiring multifamily property. Then we've got a soon to launch acquisition arm focused exclusively on workforce housing, primarily on the Gulf Coast of Florida, Sarasota, Manatee, Pinellas counties. And more relevant to this conference, we've got a funding arm that goes across all asset classes, not just multifamily. Predominantly in the state of Florida, kind of 3 to 30 million more transitional assets that need a 1 to 3 year bridge, just like everybody else here is offering. So we're gonna get into it, but I do want to just let everyone kind of know how we're trying to structure this panel, because again, we know it's Friday morning, so most people here either wanted free breakfast or they have a late flight and killing time. So we want to keep this a little more engaging and open. So I'll ask for questions at the end, but anytime during the course of this, if you have any questions, raise your hand. We'll gladly answer anything, whether it's on topic or just something you want to discuss. We're happy to discuss with you. Also, because we've all been to so many of these panels, heard all of the metrics, all of the basic article type information to this point, we're going to try to keep these a little more long form in terms of answers, a little more case study in terms of answers. I think that's going to be a little more relevant, a little more interesting at this point in the conference. So we're going to start off more on a macro level, so we'll start down at the end with Dave. As you said, Money 360 works on all different asset classes, lends on all different asset classes, one of them obviously being multifamily. Multifamily is very hot right now from a finance standpoint, acquisition standpoint. Kind of what do you see as the big driver of making multifamily so hot? Why is it something that Money 360 is interested in? Why is it sustaining such a popular stance?
Let me take that in two different parts. And one is, why is that industry continue to be so strong and so hot? And then where's Money 360 in that play? As we all know, apartments have been the darling of the industry for probably over 40 years. Part of it is the liquidity of that asset type. You can do lots of things with it. You can play it in portfolios and pools. You can diversify your pool from 6-unit apartment projects to 500-unit apartment projects and everything in between. So it can be very granular as to how you set up your portfolio. You have, as obviously, TIs and leasing commissions. People love that kind of investment where it's not a continuous contribution in. There's CapEx and turnover, but beyond that, there's very little ongoing capital requirements other than just keeping your projects current and up to current state of the art. Part of that push and drive has also been the capital that's out there and available. And as we've heard from some of our earlier panels, with the agencies now being reallocated to potentially do $6 to $7 billion a month for the next 14 to 16 months.
Absolutely, for the next 5 quarters.
That is just throwing gasoline on the fire. Will by itself help that multifamily industry continue to be one of the top sectors and top drivers?
Yeah, I mean, I think if you don't mind, Jordan, that's a place to just kind of hop in on that point. So yeah, I mean, I'm sure everyone has questions about the new allocation. So for those of you who don't know, the FHFA came out and gave the agencies Fannie and Freddie their new allocations over the next 5 quarters at $100 billion each. I have to be personally honest with you. I thought the number was probably going to be closer to maybe 50 or 60 billion. And to today's point, just touching on the run rate per month, I think the agencies were originally seeing about $5 billion or so a month, and with that allocation, it does have the room to take that up. Now, to offer a couple of points with that, what they did change, which I'm pretty sure a lot of you are familiar with, the green financing that was taking place in the marketplace, and what we call the affordability, which is the affordability of rents relative to the AMI or area median income of different zip codes. And so, they changed some of those discounts and essentially, not quote unquote restrictions, but basically how they would do business. They changed it. So they removed some of the green discounts and such. So I think that'll change a little bit of the types of deals that are getting done. So for those of you who aren't familiar, so say Noah and his team buys a deal. They want to do green financing. And what that would allow them to do is essentially get another third-party report, engineering report, that basically says, if you make X amount of changes to your property, call it, say, it's roughly about $300 per unit for utility and water savings, that you would get a pricing benefit that'll come along with that, also allowing us to underwrite to, a higher NOI essentially, because he's going to realize savings from doing that. So, they scaled back some of the discounts that they were going to give with that and removing it from what they call uncapped business. But I mean, look, I think overall it's good. I think it, will remain a player. I think it'll, create a shift from the focus of deals. I think kind of the touch points and words now, or the hot buttons for deals are affordable workforce housing. I think, with the agencies kind of moving towards that mission, which is really, to provide affordable housing into the market, and that's not just, low-income tax credit housing, but affordable housing, I think it's a positive thing overall.
Chad, something that might be helpful to the audience is to discuss, I believe you're the only agency lender up here, to discuss what happened a few months back when the agencies did start to pull back because they were hitting their caps. Who kind of came in and filled that void? Because what happened was the agencies weren't pricing at, let's say, 400 over anymore. They were, 4% on a fixed rate basis. They were pricing at 4.5, which was getting too expensive because they were hitting their cap. So again, maybe just discuss who was kind of filling that void in the meantime, and where people were getting their debt from, let's say, August to mid-September.
No, absolutely. You bring up a great point, though. And I think, that void was being filled by, quote unquote, the magic word, CMBS. I guess everyone's saying CMBS is back. I think the, quote unquote, I think the CLO space has always been there, and I think we're seeing best to kind of come back into the market and fill that gap. Now, I don't think not necessarily that they jumped in or that it was going to be inevitable. I think, like you said, I think that shift allowed them to be players once again. I think it really goes to what people are saying about the market, right? That it's healthy, it's strong, multifamily, like Dave mentioned, just continue to kind of, as we say, blow and go. I think it's just a testament to just how strong the market is, and even with, like you said, you guys jumped into development a little bit. I think you've seen new construction in markets that's continued to be absorbed. So, I think it just kind of lends to that, to what we'll see over the next 5 quarters.
You also saw a bunch of the national platform banks jump into that. I mean, the big gorilla in that business is Chase Bank. And on either coast, that was a boom for them for those 4 months. They signed up everyone that came in the door. And for a number of their competitors on the coast and in the Midwest who jumped all over that and made hay for 3 or 4 months. And I think part of that is you get a client, you finally get them away from an agency lender, and then it's this push-pull.
We don't want to say that.
As they come along as to which of those will continue on with a bank relationship or come back into an agency. And with the depth of agency pockets now, it'll be a driver for the business, both in the near term and I think over the next 24 months. To the last point that you were asking about Money 360 for us, this just gives us, we are a bridge lender, and that is a bridge to an exit. And we're looking at multifamily. We want to be assured that that exit is there. I will tell you, as much as I know that CMBS would like to be there, we just can't rely on them in that long term to continue looking aggressively at 75% leverage and good cap rates, particularly in the Midwest, in the middle of the U.S. Forget the coasts for a minute. Are they going to be there, day in, day out, and long? We know the agencies will. That gives us confidence to be a little more aggressive in Memphis, in Austin, in Houston, in areas where we're not really sure who, and don't rely on a local bank to be our exit. We know that the agencies are there. And that SBL program is a great exit for our bridge lending program.
Yeah, absolutely. I mean, and we've continued to see the SBL program grow. And I think that's both for Fannie and Freddie. I mean, what you'll typically see, for those of you who don't know, the way Freddie Mac looks at their platform, they have, what they consider to be kind of top market, standard market, small and very small market. markets. And obviously you have your concerns in each of the different markets. You know, your top markets, typically you're seeing, you know, higher rent growth, you're seeing higher pricing and valuations growing, lower, you know, cap rates continue to be compressed. And then your, you know, small, very small, and some of your, you know, Midwestern, you know, more secondary, tertiary markets, you see a little more of, you know, what I would say, less risky underwriting, you know, higher debt service coverages, a little bit lower leverage on the acquisition. And I think Fannie and Freddie do a very good job of complementing one another, you know, within those different markets. You know, probably you'll see Fannie, not necessarily a little more aggressive, but I think they have a larger book in some of the more secondary, tertiary markets, which Freddie would consider those to be their small and very small markets. So they'll underwrite, you know, on a $1 to $6 million loan, they'll underwrite to a, you know, 80% leverage on the acquisition, 75% on the refi, you know, 1.25 debt cover. Whereas Freddie Mac in that same market may be at a, you know, 75% acquisition or 70% refi, and, you know, even a 130 or 140 debt cover. So they're a little more conservative in that respect. And then, you know, even on the larger loan side, I know you guys are, you know, doing some larger transactions, and Dave, some of the markets you mentioned, like the Austins and the Houstons, and, you know, even from the agency standpoint, we continue to see the growth in, you know, like your uptown Dallas market, like you mentioned Memphis, and, you know, Nashville's been booming like crazy. And I think the agencies have done a good job. I mean, what would you guys say from like the buyer standpoint of, you know, kind of seeing quotes from the agencies? Although I didn't quote the business, I should be quoting the business. You know, we did. We have some. But I mean, what would you think from the buyer standpoint? Like, how would you kind of see the agencies relative to CMBS, you know, relative to some banks and some of those markets?
It's a really good question. I mean, I have to say we're a little biased. We historically have been mostly agency borrowers. We have, you know, we've borrowed over $1 billion from the agencies since 2009, and we like them. We like them because they're easy to work with. They're somewhat predictable. You know, to that point on agency versus CMBS. And again, I'm not here to pitch agency or CMBS. The truth is, every situation is different, every borrower is different, and every property is different. But I'll give you a perfect example. We're a pretty large preferred equity provider. We started providing preferred equity to sponsors back in 2013, and since then we've invested in approximately 17,000 units of just preferred equity business. And the majority of that has been behind the agencies. We've done some behind banks, CMBS, et cetera. The majority has been behind the agencies. When the agencies started to pull back in the summer because they were getting close to their caps and started to basically increase their pricing because they didn't want to be as competitive, all of the borrowers, all the deals that we saw for preferred equity were coming to us with CMBS quotes on them. And we were having to make a decision whether or not we were going to get comfortable going behind CMBS because we didn't know when the agency's scorecard was going to come out and what was going to happen and if they were going to get aggressive or not aggressive. The big issue, or not the issue, but the big difference between the agencies and the CMBS world is that agencies, you can pull a supplemental a couple years down the road. If you put a CMBS loan on your property, you can't pull a supplemental. That's big for anyone who has a value add plan, who has a preferred equity they have to pay back in a couple of years, because if your goal is to go in and spend, I don't know, 5,000 or 10,000 unit, push NOI, and then basically pull a supplemental, pay back your partners, you can't do that with a CMBS loan. That's the first issue with CMBS that agencies will allow. Second is rate locking. The agencies will allow you to rate lock, do an early rate lock. A couple weeks, a month before closing, etc. CMBS, my understanding is you can't do that. You have to rate lock pretty close to closing, either the day of or the day before. And I could be wrong a little bit, but that's my understanding. And you know this, I mean, look at the treasury rate, right? It goes up, it goes down. I mean, you have no idea where treasuries are going to be in 30 days, so that's a pretty big risk. In addition, servicing is kind of a pain with CMBS compared to the agencies. So, you know, I think from a convenience standpoint, the agencies are always going to be more convenient. You know, CMBS, I think, was a good option for people when agencies were pricing at 4.5 fixed rate and CMBS was pricing at 3.5 fixed rate. I think when there's a 100 basis point spread, you have to go with CMBS. But if they're equal on pricing, you're going to see agencies dominate.
Thank you, Noah, for selling hot real estate capital.
I've got a question. What about, I'm starting to see more life code, other balance sheet coming into play. Servicing is a little bit better than CMBS. Not quite the agency, but there's a gap there that seemingly potentially build in the short-term interim. Are you all seeing the same how do you compare those two options?
I'll give my 2 cents, and then you've probably done more than I have, but there's deals that we have purchased that we have gone life company quotes. They're always very competitive on rate. Where we have seen them not be competitive is on leverage. So if you are a low leverage group, then I think life companies are a great option. 60, 65, maybe even 70. If you're trying to go above that, usually we are. Usually we're leveraging our deals 70 to 75. We're trying to get full term IO. They just haven't been competitive on that front.
Yeah, I mean, I echo the exact same sentiments as Bill. I mean, the deals that I lose to life cos typically tend to be lower leverage. They want longer term IO with that as well, coming with that lower leverage. And for the agencies, you know, if I'm going to do a 60, 65% levered deal, you know, if it's a 10-year term or greater, maybe I get, you know, anywhere call it from 3 to 7 years IO. But, you know, when a life co is going to come in and offer, you know, 60% leverage, you know, 10 years IO on a deal, and they're going to be pretty competitive on the spread, it's kind of hard to compete with that. But I think what you are seeing that because the overall market is bigger in the multifamily space, and I think with especially a lot of Class A transactions that have gotten done, and you know, like Noah mentioned, for someone who's going to say, look, we're a long-term holder, you know, we believe in this market, you know, maybe we're a family operator, and they're willing to take the lower leverage and watch the value increase in the property, then they're probably going to take that life co-financing because it's going to give them some terms that are very competitive and basically allows them to execute that business plan, which is simply, you know, a long-term, you know, management play and just value appreciation strategy. But, you know, if you're in a market, call it say in, you know, Evansville, Indiana, or, you know, in the Midwest, then yeah, typically a borrower is going to be looking for, you know, higher leverage on a transaction. You know, maybe they're looking for yield or something like that, and hoping to find a, you know, a 6-cap deal. Then yeah, we're going to be the more competitive player coming in at, you know, 80, 75% leverage, throw a couple of years of IO at them, and you know, as has been mentioned, the new allocation. So we have seen spreads come in a little bit, which I think will allow us to continue to be competitive in the marketplace. And like Noah mentioned, I mean, 12 months later, I can come back and offer a supplemental. And one thing that Hunt actually did, you know, we kind of saw that value in the space behind players like Pensam, and that, you know, we became a Fannie approved mezz lender. So for somewhere that maybe, you know, was a little bit on the fringe, maybe that market hadn't quite gotten there yet, and, you know, we were only thinking that we'd be at 65% leverage from a credit standpoint or 70, you know, but the cash flow was there, and some of these call it, you know, B, C workforce housing projects, the cash flow is there because that tenant base, quote unquote, it doesn't really leave. You know, usually they work in the local marketplace or they commute somewhere else to work and they just want a, you know, a safe and healthy place to live. So we provide that mezzanine financing and take them a little bit higher in the capital stack and allow them to come back and do that supplemental financing to pull that cash out and realize that value.
Talk a little bit further about the life companies. One of the things, there's really 2 points for the life companies, and this has been historically shown. They manage their allocations to product types very closely. And what we've seen is almost every year they get aggressive. They come out January, February with an allocation for the year, but those are also tranched into allocations for office, industrial, multifamily, retail, and et cetera. And oftentimes they fill that multifamily bucket very early. So you'll often find life companies that are in that kind of mid-tier size. They're, by March, April, they're done in life companies that are going to be more conservative. But 2, and not to brag about Money 360, but that's why I'm here. Their process to get funding, if you're in an acquisition, it can be a bit tedious. They've got to go through all of their traps, and it's typically a 45 to 60-day process. If you're allowed that much time to due diligence, great. If not, somebody like Money 360 close deals in less than 30 days with very little exceptions to that. Helps to get those deals underhand, get out, do the work you need to do, then take your time to shop the right life insurance company. And clearly for long-term debt, and maybe the life companies can go in excess of 10 years. They could be out 15, 20 years or longer for the right project.
All right, continuing on the finance side first, and we'll move over more towards the asset side. We're talking about where things are relative to agency, life company, and so forth. And it seems like it's just status quo, and everything's just going, and the buckets keep getting larger, and deals get done. But we're still seeing at least talk about, are we getting towards the end of the cycle, or are we getting a little bit long in the tooth relativism? Do you see anything being put in place, maybe today, that wasn't in place 12, 24, 36 months ago? Whether it's interest rate floors, or additional guarantees, or a little bit lower leverage. Is there anything changing that is kind of protecting the lender and maybe tempering some of the risk? Because like a lot of us were lending in 2006 and 7 and 8, and we were just doing crazy shit. I mean, there was no rhyme or reason to what we were doing. There was no tempering of it, and that kind of exacerbated the downside there once everything collapsed. I don't see that in today's market. Is there something being put in place to hold that back a little bit, or are people just hoping for the best, crossing their fingers?
Yeah, there's definitely seen some limits to rent growth pro formas. So when we're looking at analysis, and guys are saying, you know, I'm acquiring this, I'm going to bump rents 7% per year for the next 2, and then 5% forever. The market's not proving that to be true. There are very few markets that are growing continuing at that rate. So rent stagnation as far as growth is definitely in place today. If you look at a study across the U.S., there are only 2 or 3 markets that are growing in excess of 5%. The rest are all at 1s, 2s, and 3s. So I think rent stagnation, as far as that growth, it's going to temper a little bit of that. And I think lenders are hearing that, and clearly the appraisal groups are all seeing that and starting to implement that. So there's a little pushback there. If you put some equity into your project, do a little facelift, do that conversion, and can bump that first time rent up a couple $100 to reflect that, great. But beyond that, I don't think you can just continue to underwrite 5% per year, you know, for the next 10 years. We're just not seeing that. We're going to see some cyclical.
Yeah. No, I agree. I mean, and look, hey, come on, let's get negative interest rates and let's just keep loading and going. Like, let's just go, you know. No, but I mean, I think you raise a very good point, George. But, you know, from the agency standpoint, I mean, look, you know, like everyone knows, we're consistent, we're in the business, you know, we're going to do the deals that we do. And to your point, you know, when I'm looking at a deal and, you know, if I need to try to push for a little more leverage, and to George's point, I mean, when things are getting tapered back, from my standpoint, you know, I've seen a little bit of the IO come in, maybe not as aggressive on modifying my exit strategy. You know, to push for a little more proceeds. Before we saw, you know, a lot of debt service coverage waivers. You know, for the agencies, to be clear, we always underwrite to underwriting floor. You know, 10-year deal, we're underwriting to 5% floor. You know, 7-year deal, 5.5%. 5-year deal, you know, 6.75% on that floor amortizing. So, you know, Constance, how you're always going to have proceeds snap back. But to that point, what you mentioned about the life codes, you know, going longer term, you know, 12, 15, 20, agencies can do, you know, 30-30 on a Fannie deal. You know, I don't have underwriting floors at that same point because we hope to have that growth, you know, over the course of 20 years. But I would say for the main point, probably the IO coming back. You know, typically you see most borrowers, they want what I call the trifecta. They want the most leverage, they want the lowest rate, they want the most IO, you know, to execute that business plan. So I would say leverage relatively the same, IO getting pulled back, you know, spreads increased a little bit. And then also too, just kind of looking at the markets and, like you said, tracking where that rent growth is. You know, we'll pull the Reese reports, you know, we'll pull co-stars and see kind of where that rent growth is. But to the point, what I will add to that though is, you know, typically what you've seen and you know, when you look at different product types within multifamily, you know, the A's, the B's, and C's, you continue to see that stronger rent growth, you know, in the BC workforce housing product, because the majority of the time that, you know, that renter falls in that middle where the Class A pricing is just out of the range, and, you know, they don't qualify for any type of, you know, subsidy, Section 8 type of housing, so they're kind of stuck in that middle where they can't pay a little bit more, but, you know, that's the choice of going out to dinner or, you know, paying that extra rent. And so I think you just have to be cognizant of, you know, that the underwriting paired with, you know, where you see the demand drivers in those markets.
I'll touch on it from again, the preferred equity standpoint, and you know, we'll call it what it is. Preferred equity is basically a mezzanine tool. You know, I don't think that we've changed necessarily our, let's say, rights and remedies in our docs over the last 24 to 36 months. I think what we've done, as kind of Dave mentioned, was we've gotten a lot more conservative on the underwriting. You know, he said he's 100% right. Markets aren't getting 5, 6, 7% rent growth anymore. They're getting 1, 2, and 3% rent growth. Austin's a perfect example. 2016, we own in Austin. We saw our portfolio getting 8% rent growth, which is astronomical. Now we're getting 2%, 3%, just healthier. Now, having said that, when someone sends me a deal in Austin, their pro forma is still showing 7, 8% rent growth. So, you know, from our point of view, we're looking at deals and saying we have to make sure that, you know, this deal works for us, even if the sponsor's not able to move the needle. Now, having said that, they're spending $10,000 a unit, we're going to give them some credit, right? If they're not getting their premiums, they're going to stop spending the money, and the money will sit in an interest reserve or a CapEx reserve account, and that'll go to pay down, you know, the debt service anyway. But we definitely have said that we're a little unsure of what the market will be over the next couple of years, so we want to be on the conservative side of that. And maybe that means that our leverage isn't as high from a pref standpoint. Instead of going to 92% of purchase price, maybe we're stopping at 90%. Or instead of going 87% of capital stack, we're at 84% or 85%. That's the only difference that from our eyes in the last 2 or 3 years.
All right, and as we're talking about the rent growth and so forth, the pro formas, what we saw a few years ago was people talking about, well, cap rates are too low and so things are too aggressive. Rents are going up too fast. We're getting oversupplied, there's too much coming on the market. That was 2 years ago, 3 years ago, 12 months ago. But yet, prices keep going up, units keep getting absorbed, rents keep going up. So when you're seeing a deal, whether it's on a finance side or no, you put more your acquisition side hat on, as prices are getting higher and higher, people are still expecting us to look at pro formas. And to today's point, to your point, people are still trying to underwrite. I just saw a deal, someone sent me a deal and they underwrote, they're acquiring a property, they're going to do a light rehab to it. They said they were going to do 7% rent growth for the next 2 years, and then they quote unquote conservatively were dropping that down to 5% into perpetuity after that. And when I said, there's no way in the world I can underwrite this deal doesn't make sense, I don't recommend you even acquiring it. They almost got mad at me and said, I own 3 other properties in this market, and sent me year-over-year rent roll proof for the last 3 years of those other properties. I don't care what happened in the last 3 years. This is not a continuous trend. Things are stabilizing out, and we're seeing that things are stabilizing out, even in otherwise hot markets like Austin. So when you're seeing opportunities to acquire a property and you're seeing it get bid up, are you being asked to, and are you underwriting to any level of pro forma, even if it's a little bit more tempered one, or are we starting to see people look more towards valuing things based on current operations today, whether it's from underwriting for valuation for finance or for acquisition?
Yeah, it's a great question. I mean, the truth is we have not been buying as much as we used to buy because it's just getting out of control. That's as simple as it is. We can't honestly look at our underwriting and say we believe rent growth is going to be 5% perpetuity. We can't honestly look at it and say we're going to get a $300 premium when the market only shows that we can get a $100 premium. So for that simple reason, we have not been as prolific as we were years ago. 2016, we bought roughly $600 million worth of real estate for our own portfolio. 2017, we bought about $60 million. 2018, we bought about $60 million. And that wasn't because we didn't have equity to put out, it wasn't because we didn't like the markets, it wasn't because we didn't believe in multifamily. It's purely because every deal we bid on got bid up by 20 other buyers who were willing to pay a lot more than we were. I think that we're at a weird point of the cycle where there's still a lot of syndicators out there who are in the fee business, not the real estate business. And they're dying to get deals to make their dollar, their acquisition fee, their management fee, et cetera. And I think that's getting a little dangerous because I think they're just bidding up properties to, up the wazoo just to get their hands on something. There's also still a lot of 1031 money, obviously, and foreign investors who are just putting their money into anything. And for groups like us, for Pensam, who again are a little more conservative, it makes it really hard to buy. You know, we're at a different point in our lifespan of the company. You know, we're sitting on 15,000 units that we own. We can easily just sit back and manage those units and have a great portfolio. So we're not forced to buy anything, which I don't want to be forced to buy anything at this point in the cycle. That's the truth. I want to be able to sit back and say, if it's a good deal, we'll buy it. If it's a bad deal, we'll pass. Now, having said that, we still find opportunities. We bought a deal earlier this year in Chicago. It was I don't want to say off market because nothing's really off market. It was only brought to a select number of buyers. It was brought to 5 people, and it had an interesting story. It wasn't a value add from the standpoint of, you know, Blackstone bought it 2 years ago and they haven't done anything. It was the value add from the standpoint of the owner bought it 20 years ago and they only own 1 deal and this was it. They haven't done anything. And by that I mean anything to the interiors as well as the exteriors. I mean, the roofs were basically falling apart, the siding was basically falling apart, the windows were no good. The plumbing was shot, the boilers, the chillers, everything was in terrible condition. That's the kind of stuff that we like today. Because we don't mind going in and spending $20,000 or $25,000 a unit. We're not going to go into anything today that we're spending $5,000 to $6,000 because it's an artificial value add. By slapping on new cabinets and new countertops, you're just continuing this cycle of hoping that you get another $50 or $100. We're in more the repositioning business in today's market, and that's what this deal in Chicago was. It was a repositioning play. So those are the deals we'll go after. And on the other side, we've also bought a couple more newer core deals that we've liked. In markets that we believe in long term, deals that we're buying at a good basis, and deals that will basically flip a coupon for the next 10 years. So, you know, again, we've changed our business plan over the last couple of years because historically we were the value add buyers. We'd go in and buy a unit or a property and spend $10,000 a unit, hope to push rents 150, 200. But again, I think it's hard to buy those deals today.
George, for us, I guess we're in a favored position because we're a rich lender. We come in, on multifamily, we'll lend 75% of loan to value today of purchase price. We'll structure in good news money. So you can pro forma whatever you want. We're going to obviously size to something reasonable, and ultimately, when we get an MAI appraisal, we're going to ask them to give us a stabilized value. And we're going to argue about it, but ultimately, the appraiser is going to be the mediator there. We will lend you up to that 75% of stabilized. So good news, value creation. If you can do that, and if you can bump your rents and execute your business plan, great, then we're out. So for us, like, we have an insulation against that because of our structure. We're not lending at 80 or 90% day one. We're doing 75% of today, and then we'll continue with you and help you execute the business plan.
I mean, I think we're in the same position, you know, so from an agency standpoint, I mean, everyone knows where the agencies are. I mean, our bridge platform, I mean, we take the similar approach to, you know, Dave and his group. We're going to lend, you know, 80% of cost, you know, 75-80% of cost depending on the market, you know, roll in CapEx. You know, I think where the majority of the bridge players are, you know, sub 300 today on spreads, you know, L285. To give you a prime example, we got a deal down in, you know, Birmingham, Alabama, L285, 300 plus units, you know, $30-some million loan, and buyer was able to, you know, secure the property where, you know, average rents are 93 cents a foot, and the market's showing, you know, over $1 up to $1.06. So when you can demonstrate that business plan, I think, you know, we as bridge lenders and lenders have the ability to get creative and want to help you structure a deal that works. You know, same thing, good news money, you know, future funding and things like that, or, you know, having you hit steps and hurdles along the way. But, you know, George, to your point, I think that there is some pause for concern, and I think it becomes a larger macro perspective as well, too. You know, the issue or, you know, complexity I'll say that I have selling to my bridge group is, you know, what's the story of the market? You know, I like to get out and see a market and know what's going on versus just, you know, hopping on Google and, you know, throwing a few aerials out and pulling a CoStar report and saying this, you know, where are people hanging out? You know, where are the type of jobs that folks have? You know, now you hear a lot about the, you know, remote working space. You know, I think the last article I saw, and it was in, you know, a lot of high urban and, you know, tech areas where folks are buying properties on the, you know, the outer skirts of those markets where, you know, remote workers are making 6 figures. You know, so there are people who want to live near the urban core, and there are some who have families in Dunn and they work remotely, but you know, maybe their partner has to drive into the urban core to get some work done. So, you know, those are the type of deals where we're going to look for, and you know, try to get aggressive on a bridge. But I mean, yeah, I would agree when you know you have some lenders who are pretty aggressive today. You got to have some pause for concern and look for the positive demand drivers, you know, overall on a property where you're going to be able to drive that rent growth, and you know, look at the business plan. You know, our group, we're going to look at, you know, just like Noah mentioned, they're willing to go in and put in 15, 20,000 a unit. Yeah, I mean, everyone will say that today, but, you know, we've gone to the standpoint of even saying, hey, okay, you're going to put those dollars in a unit. I want you to drill down for me. You know, what are you going to do in kitchens? Are you doing granite countertops? You know, are you doing porcelain floors? Are you doing tile floors? You know, are you doing new windows? Are you doing impact? You know, or are you doing energy saver? Are you doing low flow toilets? Like, we've literally asked for them to drill down specifically into these things that are, you know, letting us know that maybe they're not the largest institutional player, but that they can operate and underwrite and execute a business plan on an institutional level. And we're willing to help that sponsor that has, you know, 8 or 12 units get to the couple thousand units by being able to demonstrate that they can be a smart buyer and a smart owner-operator, you know, to withstand some of the headwinds that we may have coming.
And no, I've got to think you're keeping an eye on rent control. I mean, we've seen what it did to New York, immediate effect. California is pushing along on that, and I believe there's 12 other states that have initiatives going that'll come within the next 2-3 years, and rent control's going to be a bitch.
But before you go, I'll say, hey, they're moving money to Miami.
It's a great question. It's something that is not talked about as much as it should be, because it's kind of like that red flag that keeps popping up, but everyone says, oh, it's not going to happen here, it's not going to happen here. I'm not going to predict whether or not it's going to happen in Florida one day. Who knows? You're clearly seeing it in some more liberal states, especially on the West Coast. But I think last week California just came out and said that they're trying to pass a bill that is going to cap rents at 5%, and they're expecting that to pass. You saw it in New York, we're seeing it in Portland. There's a lot of areas we're seeing it in, and it's scary. Fortunately, we don't have anything in those markets, but I'll tell you, we deal with a lot of groups who own in New York, and they said overnight the values that they lost was astronomical. And those groups now are going to markets like Florida, like Kentucky, like Georgia, kind of these somewhat more secondary markets that haven't been as high quality institutional because they are scared to death to invest more in California and New York. So on one hand, Chad, you're right. They're coming to Miami and they're going to jack up prices in Miami. But the truth is you just never know where it's going to be next. And that's a scary thought. That's a very scary thought.
I mean, and I agree with you. And, you know, one thing I will say, being an agency lender, that is something that obviously, because of the discounts that we're giving to properties, you know, where we feel that rents are, you know, lower relative to the area median income, you know, I think it's something that the agencies are tracking and that they're looking at it. And you know, we've asked questions and would like to know more about it, which is why I also see, you know, I think you see the push to, you know, to facilitate and help fund affordable and workforce housing. You know, I think the big thing that goes along with that is that, you know, for years you've had the urban and coastal cities that experienced hypergrowth because, one, there were jobs, there were good paying jobs, there were great schools, people could, you know, have access and find mobility in what they wanted to do to plan out their careers and their lives. And some of those markets that you mentioned that aren't as, you know, have the institutional buying power, you know, there, they didn't have those factors as well. And I think as you start to see the job shift, the migration shift, I think you'll see it come to those markets. So yeah, I think it's something you definitely got to watch and pay attention to. And I agree with you, it is scary because, you know, if you are an operator that has a value-add business plan, you know, how do you go in and execute that? You know, when you may be capped in something and get caught in a, you know, if you got a 3 or 5 year business plan and get caught in the middle of it, it's pretty scary.
Yeah, I mean, listen, there are warning signs to it. You'll see certain, you know, state senates proposing legislation, right? So if you have to assume it's not going to pass on the first time around. So for example, if they started proposing it, you know, I don't know, 6 years ago with New York or something, so you can kind of see that it was going in that direction. So just, you know, if you see an article that says something like, you know, Georgia State Senate puts a bill out there for rent control, and maybe it's not going to pass this year, but you need to start thinking, what happens if I am still buying properties there? Because eventually something will happen. So that's definitely something that everyone in the multifamily industry, whether you're a lender, investor, developer, et cetera, needs to start paying attention to.
Yeah, and don't forget, even if you see the writing on the wall, if you look at California, it's actually retroactive back to March. So even if you saw it and you were jacking rents up these past couple of months, yeah, they stuck it back there. But talking about that, sticking with that same theme here, as prices go up, we all kind of know at some point in time, whether it's rent control or something else that happens, things should slow it down, if not, hopefully not, but potentially reverse it a bit. What are the kind of things you guys are seeing or reading about or talking about that could eventually slow this down, get buyers closer to where they need to be, get sellers to start coming back down closer where buyers need to be? Because Chad, you talk about affordable workforce housing, and that's something that I also focus on. And part of the problem and part of the reason it doesn't really exist in the market, and we have millions of people that can't really afford to live someplace, is because these syndicators, these value add buyers, as prices went up and up, it's just like, I look to acquire workforce housing, I can't pencil out a single deal. I mean, no matter how hard I try, because someone's coming in saying they're going to pay $80,000 to $100,000 a door and put $15,000 in and put vinyl plank flooring and stainless steel appliances and double the rents. So then you start seeing places like California, New York, or implementing rent control to curb that. But right now, it's just, as prices go up, you're kind of only selling to one person. So what is going to happen? What do you think is going to happen that's finally going to slow that down and maybe help correct the problem as a whole before governments have to step in and correct it?
One of them, I mean, just the supply-demand issue, there's been very little provided. Yes, since 2011, it's been very slow to go to get started, both housing, single-family housing starts and for multifamily. But right now, it's at an all-time high. So there's going to be a lot of product coming into the market and more choices, and I think that's going to temper a little bit of rent growth. I think too, just this, we talked earlier about rent stagnation. If that pro forma is not going to be bouncing up, and it's going to be assuming that 3%, not 7s and 5s, I think that's going to close that gap a little bit between buyers and sellers. Saying that, the challenge is there's more capital than ever in the market. As we've already seen, Europe is in turmoil as far as where they can find yield. What we're already seeing is they're finding yield here in the U.S. So we're going to start seeing, I think, in 2020, a huge inflow. We have no idea what Brexit's going to do and the impact of that, how that's going to sort out. But it's definitely going to have a global impact to it. But I think that with the construction and the rent stagnation, I think that's going to help bring that gap down.
Yeah, I definitely agree with Dave. I think that coupled with, the agencies are trying to institute new products, George, to definitely help in that space. Freddie Mac has a non-LIHTC workforce affordable housing forward. I mean, it's up to 30 months. You can do a forward commitment. You can lock at your construction term. I'm actually looking at a deal right here in Alabama now with that, $187 million project with $30 million loan where, we plan to lock our rates simultaneously with the construction loan and, have our construction line go right along with it. So I think, I think the focus hasn't been on creating innovative products to support that market. I think the focus was always, hey, let's create something for low-income tax credit housing. But what you had was that entire segment of middle America which didn't qualify for that product. You couple that with NIMBYism and people not wanting affordable housing in their backyard and whatever the mindset and thought place is about the tenants who live in those buildings. So I think the institution of new products to help in that space, one, is going to help. Freddie Mac's looked at purchasing tax credits, to put us on pace with kind of some of the direct buyers like the Wells and the Chases of the world, like you mentioned earlier. So I think you'll start to see some stronger products coming out with the agents for that to create more product. But I think to your point, what you mentioned as well with geopolitical, governmental, things like the inclusionary zoning and changing some of these rules, that allow, developers and owner operators to put up projects in workforce housing where someone isn't living, an hour away from their commute and working. I think if you can get more of that product in the marketplace and give incentives to do it, for instance, with that same Freddie product, if you make 10% of the rents in the project at a certain AMI level, they're willing to give you, tax breaks, and they want you to go to governor and ask for pilots and things like that, or sorry, not the governor, but the, local county officials to ask for pilots and, tax abatements and things like that. So I think it's going to be kind of the village approach to getting it solved, but, I think there is some relief coming.
I think these guys are spot on. I don't have much to add. I think you covered most of it.
Well, I'd be curious if HUD is stepping in. So also, we've talked about Fannie and Freddie. HUD's also realigned themselves going forward.
Yeah, so I'm happy to share a little bit on HUD. We haven't had a lot of defined things coming out, so I don't like to speak before we have something really defined. But what HUD has talked about, with the 221D4, we're actually doing 3 of those projects down here right now, is that they're actually talking about for the 223F, actually for the purchase loan, which is a 35-year term and a 35-year amortization. Today that thing probably prices somewhere around 3.6%. So, you're seeing a lot of folks who want to flock to the HUD product with the lower rate and the longer term, but they don't know about the reporting and the fees. So HUD's talking about trying to streamline some of that stuff with the reporting and the fees, and they're also talking about waiving the requirement that they have. So just give you an example, if Noah and his group goes out and they build a great project and they say, hey, this is going to be a legacy asset for us, we want to keep this thing for the next 30 years, let's talk about a 223F loan. Usually what I tell him is, hey man, you gotta wait 3 years from CFO before I can give you a 223F loan. So they're talking about waiving that requirement and allowing folks to do that. And that too, I think when, the other piece of that would have to be that you have to have the mindfulness of the operator and developer. And I think with that coming, you're seeing a lot of these impact funds that are coming out and want to build these sustainable projects. So I think you have to couple that impact fund, mindful developer with that product for somebody who's going to say, yeah, I'm going to purchase a product, I'm going to put a 35-year loan on it, and it's going to be in the marketplace, and I'm not going to sell it because there could be the value add buyer who comes in and says, hey man, you've got some great financing terms on that deal, I can come in, buy that, and 10 years down the road, once that prepayment expires, maybe I pay this deal off because I've had such a low rate and low debt service on the project. So again, something coupled with that in mind, more talk and discussion has to be had around it, but they certainly are looking at how to grow their business in the marketplace, and we're looking at doing it.
All right, we only have a couple minutes left, so before we give any parting thoughts, I just want to make sure that it's time. Does anyone have any questions or? No? All right. Just to kind of close this out, we were talking about California, talking about some other places. But let's go pull back a little macro to finish it off. Are there any particular markets, whether it's specific to an individual MSA, state, or region, or even just something general like urban or suburban or whatever? Where are you focusing? What markets do you think are more sustainable going forward for these next few years? And possibly which markets are you trying to avoid that you think could be problematic before some of the others?
So let me say this. I'll say one, follow the big boys, follow these guys. No, but there is some truth to that. What you see with a lot of institutional players is they usually have a lot of data and a lot of information. For instance, like Hunt, we also own a management company. We're the third largest property manager in the country. So, we see a lot of trends around. So I would say your markets like, your Nashville's, I'm pretty bullish on the DMV area. You're seeing huge growth in DC. And so kind of the Maryland and Virginia that's benefiting from that. I've seen some very small markets where a deal I financed back in January, The borrower literally just came back to me last week. We had lunch, and he's like, "Hey, I got a guy coming in to pay almost $1 million more than what we refinanced this thing at." But it's because he's in the sight line. You know, there's a commuter town that's about an hour outside of DC, and everyone's passing right by his property. And funny enough, we're talking about potentially refinancing and putting HUD loan on it and covering his prepay. So, you know, I like the DMV area. Obviously, I like the Carolinas. But I more so tend to look at the places that have some strong, you know, jobs and demand drivers and where people want to be. So I like the Southeast. You know, I like the Florida markets. I like your Texases, your Austins. The Midwest, I think there's still some opportunity to get some decent pricing there. But you're still seeing migration in, you know, the Sun Belts, the Phoenixes of the world, you know, where we're seeing a lot more kind of independent senior living stuff being done. You know, yeah, I'd say those are probably my kind of top ones.
For Money 360, we're a national lender, so we're nationwide, and I guess we've got a niche in that we will go to secondary and tertiary locations. But even saying that secondary and tertiary, there's going to be strong markets out there in those secondary locations with some sort of major job demand driver. We too are going to follow the big boys. We're probably not going to be financing those entities, but we're going to finance the guy who bought the project across the street, next door. We've seen a number of transactions where it's just old tired C quality product, but the bones are good of the piece of real estate, the location works, and we know if it's a $10,000 or $15,000 per, that we can develop a nice project and take that to a B+. So nationwide, that's kind of our place to play.
Yeah, I mean, we've always had the philosophy and mentality of case-by-case basis depending on the location. Obviously, you can take any state or city and say this is good or bad because of this or that. We've always taken the approach of a pocket perspective. Is this pocket a pocket we like because there's a good demand driver there and housing is affordable there, et cetera. Having said that, though, I do think Florida as a whole is a great place to invest, and you can, you know, it's obvious why. People are moving down here by the hundreds each day. I think it's the top growth state in the United States. If not top, it's in the top 2 or 3. Top 2, and Texas is there too. And it's because it's somewhat affordable to live here, the taxes are low, and people want the lifestyle. You're seeing them move from the Northeast all to Florida every single day. So I do like Florida. It's almost impossible to buy here, and it's because it's no secret that Florida is a great place to invest. But I do think long-term, Florida is going to be one of the best places to invest in the country.
And to add to that, Jordan, I think one thing that, you know, everyone, you know, I'm sure everyone looks at it here, I think that folks should look at are the types of jobs. You know, jobs that are offering that flexibility, you know, where folks can work remotely and, you know, allowing folks time off to, you know, there's the push to kind of the work, live, play, healthy lifestyle. So, you know, people want to be in those companies where you sit and, you know, you're seeing the healthcare spaces being large and things like that. And, you know, tech and by tech, I mean like, you know, IT consultants and security. So I think those are some of the things you got to pay attention to.
All right, we were getting the hook there a second ago, so if you have any parting words or anything you want to sign off on, otherwise.
Thank you guys for showing up and sticking with us here on Friday afternoon. I appreciate Crittenden putting this conference on and letting us talk to you guys.
I echo all the same sentiments. Hope everyone has a great weekend.
Why not? Same thing.
And the same.
Thanks,
I
guys.
do apologize. We did talk about having a Bloody Mary bar here, but
Next year.
Next year.
Let's have a